Hello everybody, welcome back. So in this video, we're going to talk about trade by the numbers and what it is that trade by the numbers does. So to really explain trade by the numbers, I have to rewind several years ago. I've always traded market structure, meaning that I look for these types of patterns in the market. Okay, patterns where price is making higher lows and higher highs and then retracing back into that prior area, and then I'm looking for a move higher. So the one thing that I was missing was a truly objective way to identify a zone. For example, should I label this a zone? Should this be labeled a zone? Should this area here from this high down to this low, should it be labeled a zone? What I was seeking was a way to automatically plot zones. And if I was able to do that, I could then backtest strategies to determine what strategy gives me an edge. And then more importantly, what kind of an edge? What's my average winner? What's my average loser? So at Trade by the Numbers, I have taken all of these data points, and I'm gonna let me get rid of all this information here. I almost deleted my chart. And let me apply an indicator really quick. Okay, so here's an indicator, and this is what I use to actually plot the zones. So all you're seeing is the output. All you're going to see with the buy-sell zones is a boxed-in zone that is either a buy zone or a sell zone. But what you don't understand is what happens behind the scenes. So this is giving you a bit of a look under the hood. You can see that every single bar that needs to go into the bar count to determine whether an area is a buy zone or an area is a sell zone, you can see every bar is labeled. It's either labeled with a number or it's labeled with a letter. And what's happening is this algorithm at the close of every bar is determining whether this bar needs to go into the calculation to determine if we have an area that we would expect price to come back into and react. And so when I remove these numbers, what we're left with is just the buy zones. And this is the free indicator that you guys have, which will plot these zones for you. So I'm going to remove all of these bar counts because it's really confusing and we don't need it. Really all we need is the output. So now I'm going to remove these and I'm going to give you guys the output. Okay, so here we are. So now what we've done is we've objectively identified market structure zones on this chart. So what we can see here is we have a red zone up here, which is a sell zone. It's the only sell zone that we see on this extended move down. This would have been during the COVID lows back in March of 2020. And you can see quickly here, we create a nice buy zone here. Price comes back in, reacts, moves higher. It does come into this sell zone, and we do initially get a reaction out of it, but it comes into this buy zone, and that's where the move happens. Okay, so Trade by the Numbers is able to then take these zones and actually run them through a database. And we can test all the way back up to about 20 years. That's about as far back as the historical data goes, unless you want to go pay tens of thousands of dollars to get additional historical data. But I think 20 years is enough. It takes us through 2 major bear cycles, so we can get a really good idea of how market structure has performed historically. And most importantly, if you think about stocks, there's a ton of stocks out there, and not all stocks are created equal. But with these tests, we can get a really good idea of which stocks really trade by these principles and these patterns. So let me kind of give you an idea of what that looks like. So here is a test. This runs through our database, and you can see that every zone gets labeled with a unique identifier, and that unique identifier, the BSG, that just stands for buy sell green, so this is a buy zone. If I were testing the sell zones, it would say buy sell red, and then it gives me the stock, which is the C, it's Citibank, and then it gives me the date. This is 2001, July 12th, and then I'm sorry, the C actually is not the stock. I'm corrected. That is inside of the pattern. My bad. So here is the pattern. So you have your zone ID, which tells you when the zone printed, and then you have the ID for the pattern, which tells you what time the pattern printed. And then you can see in here, I have a bunch of metrics. Not all of them are filled in, but I have a bunch of metrics that I'm able to then use to determine what areas have the highest probability. I can now take this, and my market structure zones in essence come to life. Now, what do I mean by that? Well, what I can do is I can take a zone and I can say, all right, a zone with this type of criteria, this size, it has an average win of X and an average loss of Y. And what I mean by size is the size from the high to the low. Depending on the size actually changes the risk profile of the zone. And I'm sure this isn't a huge surprise to you, but if you have a larger high to low zone, you have a lower, what I would call reward to risk ratio. And that reward to risk ratio is, on average, if I'm going to risk $1, how much can I expect to make in return? So if we look at the zones as a whole, here are some numbers for you. On average, and this is over the course of 20 years, testing the stocks in the S&P 500, there were 22,158 trades. And then out of those trades, the average winner, and this is assuming that you're risking a straight $100 per trade. So risking $100 per trade, the average winner ends up being $379. Now, how do I arrive at that number? Well, what I'm using is I'm using a volatility metric to determine how much to risk, and then I also use the volatility metric to determine how to trail a stop. Okay, I'm not going to get into that in here. This is just very basic. There's a million ways to trade these things, but that's how this was done. So the average winner is $379, and then the average loser I have to do that here. The average loser is $93. Now, why would it be $93 when I'm risking $100? Well, again, it's that trail, right? So the trailing stop allows me to actually reduce my risk overall. Not by a lot. I mean, my average that I'm risking is $100. Now, keep in mind with stocks, there are going to be times that I lose more than the $100 because I'm carrying stock trades overnight. And so you do have occasions where that next morning the stock could open lower than your stop. For example, if my stop is here and the next morning price opens here, I'm going to lose more than what I was expecting to. But this is also why you want to keep your risk at a minimum and spread it across many stocks. So anyway, this is just a quick summary of what we do at Trade by the Numbers. Now, I want you to imagine taking your trading knowledge, all the knowledge that you have in trading today, maybe it's other systems that you're using. Imagine taking that and then using these zones and stacking that on top of what you already know in the market. So you have a daily chart and you get an alert that tells you CSX is inside of a daily buy zone. Well, why can't you at this point take your other knowledge and apply it to entering this trade? Maybe your trading system would tell you this is not a good area to be trading. Maybe it'd tell you this is not a good area to be trading. Maybe this bar right here is a beautiful bar. Maybe this is where it tells you this is where you should engage. And if so, that ends up being a hell of a trade. Anyway, that's the whole idea here. Take these zones, use an objective way to identify market structure, and stack it on top of what you already know in the market. Okay, that wraps up this video. In the next series of videos, I'm going to walk through the indicator that you have on your chart, and I'm going to tell you how to apply it, and I'm going to tell you what the various settings are so that you have an understanding of what you're looking at and what settings you can change and what those settings do. See you in the next video.